Good evening. It is Saturday, January 31st, 2026. And if you have looked at the markets today, you are staring at a historic anomaly. Silver has just experienced its largest single-day percentage collapse in modern history, crashing over 26% from yesterday's high of $118 down to $85 where we sit right now. To put this in perspective, this move is more violent than the Hunt Brothers crash of 1980 and sharper than the 2011 reversal. On paper, it looks like the end of the bull run. But if you look deeper, what we are witnessing isn't a market correction. It is a liquidity vacuum meeting a structural break in the global metal supply. I'm Ken, and this is Behind the Rich. Today, we are taking apart the mechanics of the last 48 hours to show you why the price on your screen has completely disconnected from the metal in the vault. While the spot price, the paper price, was imploding on the charts, the physical market effectively froze. Reports are flooding in from major dealers like Bullion and Bullion regarding severe technical delays. We are seeing customer service queues backed up and order processing times stretching into weeks. Here's the critical data point nobody on cable news is discussing. At the exact moment silver dropped $33 per ounce, physical premiums exploded. The spread between the paper price and the cost to actually get metal in your hand just hit a record high. Why? Because while algorithms were selling contracts, humans were buying metal. So what actually triggered the algorithm to dump billions in paper contracts? It started at 10:15 a.m. yesterday morning. President Trump officially announced the nomination of Kevin Warsh as the next chairman of the Federal Reserve. The market reaction was instantaneous. Warsh is viewed by Wall Street as the ultimate hawk, a signal that interest rate cuts are off the table and real yields will remain elevated. The US dollar index surged 2.3% in hours. When the dollar spikes that hard, dollar-denominated commodities mechanically reprice lower. This gave algorithmic trading systems the signal to initiate short positions. But that was just the spark. The fuel was something much more controversial. At 11:37 a.m., a report circulated via Reuters, citing unnamed sources that the U.S. Energy Department was preparing to release strategic reserves of critical metals to cool the market. Computerized trading models, which now account for the vast majority of volume, reacted instantly to the headlines. They didn't verify the data, they just executed sell orders. Silver plunged another $12 in 20 minutes. 3 hours later, the Department of Energy issued a formal denial, and Reuters retracted the report. But in modern markets, the truth often arrives too late. The initial sell-off had already triggered a cascade of stop-loss orders and margin calls. Once that liquidity is wiped out, the price doesn't magically snap back. The damage to the chart is done. Add to this the calendar. Today is the last trading day of January. It's month end. Hedge funds are marking positions to market, and liquidity is naturally thin. COMEX raised margin requirements on silver futures overnight, the second hike in 3 weeks. But now you need to look at what didn't change today. The fundamentals of the physical market are actually tighter now than they were yesterday. First, industrial demand. The solar photovoltaic sector is still on track to consume over 230 million ounces this year. That demand is inelastic. Manufacturers cannot stop production just because the paper price is volatile. Second, geopolitics. The export controls implemented by China on January 1st are still in effect. Chinese silver is not flowing freely to the West. Furthermore, the Russian central bank's initiative to accumulate silver in its state reserves, allocating billions of rubles through 2027, is proceeding. Sovereign buyers generally view price crashes like today as a discount window, not a sell signal. Third, inventory. COMEX registered stocks, the metal actually available for delivery, have plummeted. We started the month with significant outflows, and registered silver is sitting near historical lows around 113 million ounces. With open interest in March contracts exceeding 500 million ounces, the leverage ratio is over 16-1. That leverage remains the single biggest risk to the exchange. Here's the reality of the situation. We are witnessing a bifurcation of the market. We have a paper market trading at $85 based on leverage, interest rate fears, and algorithmic flows. And we have a physical market where dealers cannot keep stock on shelves, lease rates are spiking, and premiums are soaring. This is the trap. The market psychology is designed to make you panic at $85. But if you try to buy physical silver today, you aren't paying $85. You are paying spot plus a massive premium, pushing the real price much higher. As we head toward the March delivery contracts, this disconnect will have to resolve. Either the paper price rises to meet the physical reality, or the exchanges face a delivery crisis where they simply cannot find the metal to meet obligations. Do not confuse volatility with value. The price has changed, but the scarcity has not. I'm Ken. This is Behind the Rich. Stay skeptical and watch the physicals. We'll see you in the next update.